All righty, here we go. This is Michelle Garcia. I'm a realtor here in Coeur d'Alene, Idaho. I work at Windermere Coeur Realty, and I'm here on the line with Janie Roth. Say hi, Janie.
Hi, my name is Janie Roth, and I am a mortgage loan officer with Idaho Central Credit Union.
Awesome. And so I'm going to be talking to Janie and sharing with the listeners some things about, she works, as she said, with a credit union, and just some things about the housing market, getting a loan, going for a loan as an investor versus maybe even a first-time home buyer. So we're going to go over a bunch of things, and let's just jump right in. So Janie, I know you have an extensive background in lending, and you worked at a large bank prior. So give us kind of a snapshot of your background and how you came to kind of your current role there at Idaho Central.
Sure. I started out in the business probably about 15 years ago as a realtor, and I sold real estate for about 10 years. But during that time, our brokerage decided to open up their own mortgage loan company. So we had a mortgage company within the office I worked at. So I became a mortgage loan officer as well. So I was a buyer's agent and a mortgage loan officer for that company for about 5 years, and a real estate agent for 10 years. We decided to move up to Idaho, so at that time I interviewed with a large bank, and I became a mortgage loan officer at a large bank as well. During that time, we kind of had the mortgage crash, and then I ventured into the retail side where I did some small business lending and managed a branch for a while. After I saw that the market was starting to come back and things were looking pretty good, got back into the role of a mortgage loan officer, and here I am.
Nice.
Yeah.
And so, I mean, we can say the large bank. It's not like it's a secret. So you were managing U.S. Bank here locally, right?
Yeah.
And, you know, sometimes I forget about that you were a realtor
yeah.
because I always think of you as the money girl.
I like to be the money
that's
girl.
Awesome that you have that background, that in your background too.
Yeah. So I know kind of both sides, which does help me as far as purchasing. When customers do come in and they want to purchase a property, I kind of know both sides. So it helps me to be able to relate to the real estate side as well as the loan side. So it's kind of nice.
Right. Okay, and give me the lowdown on kind of credit union versus getting a loan from a traditional bank versus like an independent mortgage broker.
Yeah. Well, I worked for all three. So as I worked for a mortgage loan officer as a broker, that's completely different. So that's a brokerage that comes together, and what they do is they have, for example, the other banks and wholesale companies will go to them and ask that company to use them for their loans. So when I was a broker, worked for a brokerage, I could shop for different loans. So you would not necessarily go with one lender. So sometimes I could go with Wells Fargo. Sometimes I could go with U.S. Bank. Sometimes I could go with STCU. So it just, you have different programs to shop from. And the fees are all about the same, so there's not really a difference there. Another difference could be that they might be able to shop for wholesale companies that sell to mortgage brokerages that might have different types of loan programs.
Okay.
Go ahead.
Go ahead. No, well, I was going to say, so what's the benefit then of a credit union or even a traditional bank?
Well, a traditional bank, they sell mostly to Freddie and Fannie, and they are for example, when the crisis hit, you saw all the mortgage brokerages go out of business because they don't have a lot of capital. So when times got tough, they had to sell all their loans and go out of business. So when you work for example, U.S. Bank during that time, they did just fine because they have a lot of working capital within the company. So they were able to continue to do loans. And They have to sell any of their loans except to Freddie and Fannie to just make more loans. So that's, and the same with credit unions. It's the same. They sell to Freddie and Fannie. They do mostly those type of programs. But each, for example, larger banks pretty much just stick to their own programs, and they'll have Freddie and Fannie in their portfolio products. And some of them might do VA and FHA. U.S. Bank didn't do Idaho Housing when I worked for them, whereas credit union, we do VA, rural development, Idaho Housing, FHA. So plus we have our portfolio products, and we do conventional Freddie and Fannie. So that's,
and are the fees much different than from a credit union for an individual going for a loan from a credit union versus the bank?
It depends on the bank. I mean, even with credit unions, there's a difference between fees from our credit union to Numerica Credit Union to STCU. So really, it's whatever the bank fees are will vary per bank. So
okay.
It really, sometimes, for example, like when I worked at U.S. Bank, we had a documentation fee, we had an underwriting fee, plus we had an origination fee. So there were a few more fees. And with our credit union, we just have an origination fee and an underwriting fee. Where I know another credit union will have an origination fee plus a point they add, so actually kind of two, plus they'll have an underwriting and a documentation fee. So it really just depends on the bank and who you're shopping.
Yeah, and so we just, as someone going for the loan, our clients would need to really do their own due diligence and really understand the fees that are going to be charged.
And fees are different. I mean, there's bank fees, which are completely different than the other closing cost fees.
Right.
So bank fees are just mostly origination fees, documentation fees, could be they charge a point, could be underwriting fee. So really look at that on your closing disclosure, what the bank is charging you.
And that kind of takes me into my next question about the different types of loans, and some of those fees will vary depending on the type, right? Like whether it's VA or FHA, conventional. Can you kind of go over just some characteristics of each of the loan options?
As far as our fee for Idaho Central Credit Union, our fee is really the same per each loan.
Yeah, and I don't mean just the fees. I mean, if you can kind of give me an overview of just the different programs out there. Yeah.
Sure. We have conventional is your conventional mortgage, and ours starts with you can go as low as 3% down on our mortgages. So that's kind of nice for first-time home buyers. And you can go up to 4 units depending on what you're purchasing. So you can purchase up to 1 to 4 units. Let me see. You can do a 10 to 30-year term. 620 is our minimum credit score. And these are your conventional loans that are sold to Fannie Mae. So this will stay in Idaho Central. We service the loan, and it just stays within our bank.
Nice.
FHA is the Federal Housing Association, so it's a government-backed loan. It requires 3.5% down. Closing costs can be, you can have closing costs contributed by the seller on this, and so that's kind of nice for first-time home buyers. It kind of helps them out, and that's the max is 3%. You can also have gift funds on this product as well. Minimum score, can go as low as 580. It just depends on the person applying for the loan. So
okay.
those credit scores will vary a little bit. It says that it can go to 580 to 620, so it really depends on and you might have additional guidelines for that. But it's nice to be able to only put 3.5% down for first-time home buyers.
Right, sure.
However, there is a maximum loan of $275, so you can't really go over $275,000 on this loan.
On the FHA?
Yes.
Oh, okay.
For VA, that's zero down, so that's nice. And it's for veterans, so you have to either be an active or reserve or retired military. That's 100% financing. However, borrowers are still responsible for their closing costs. They can get gift funds on this as well. It's a 15 or 30-year term. Maximum is $453, so just a conforming loan amount on this one. You can do 1 to 4 units, and the minimum score is 580 on that.
Okay.
For RD is also a rural development, so this is for people who live in areas that are with a population of 20,000 or less. So,
and so in our area, what would that qualify for or not?
Very kind of certain parts of Spirit Lake, Athol, certain parts of Post Falls. You really have to get the address and then you put it into the rural development website, and they'll tell you whether or not that address qualifies.
And this is the same program as what's referred to as USDA, right?
Correct.
Yeah.
Formerly
okay.
USDA, yeah. And that's 100% down. However, you can actually finance some of your closing costs into this loan up to 102% loan to value. So that's kind of nice. Yeah. Okay. You can get closing costs contributed up to unlimited. That's unlimited on these loans. There's no loan limit on these as well. Primary residence only, and minimum credit's about 620.
Okay, and I seem to remember one of these had an income limit. Is that right?
Yeah, actually the RD has an income limit on that.
Okay.
I don't have
and then,
that. You have to look it up per county and kind of see what that is. I think it's about $58,000 a year.
Okay. Okay, well, we'll check on that. And then what are we missing? Idaho housing, right?
Oh, yep, Idaho housing.
So tell me about that.
Is great for first-time home buyers or for buyers who might have limited funds to put down on their home. Basically, there is also a maximum income of $90,000 on this program. You can do 3% down and then have a good credit second for 2.5% of that. So we have down payment assistance on that as well, where the borrower only has to bring in 0.5% of the purchase price, which is very nice.
Yeah, that's awesome.
So
okay, and by a good credit second, what does that mean?
So a good credit second is a second loan on the property, but it's just for the down payment assistance. So,
right, but I mean, what do they consider good credit?
You have to have a score of 640 or above to qualify.
Okay. Okay. All right, and then.
And it also has one more feature, which is kind of nice, is a closing cost assistance as well. It does bump up the rate a bit on the loan, but you can get up to $1,500 of closing cost assistance on the loan as well. So it's really nice for those first-time home buyers that have limited funds to bring in.
Okay, and you mentioned the rate. So what are we looking at right now as far as rates go?
Well, depending on which, there's a couple different programs in Idaho housing, but just for what we call conventional is between 4.25 and 4.5. And
that's bumped up in the last several months, right?
Well, rates have actually gone up quite a bit in the last 2 weeks. We had 3 rate changes, so they have gone up 0.1% to 0.25% in the last 2 weeks. So we're in that type of environment where, the job market's doing well, consumerism is up, which makes the stock market increase which increases rates. So rates are kind of, hopping up a little bit every week.
Okay. Okay, so if someone's listening to this and they're thinking about doing something, what's your suggestion?
My suggestion is to do it now. Because, and you know this, as the housing market out there is, as more people see that interest rates are rising, they start to get off the fence and start shopping for a home, and inventory starts to kind of go down, which makes it a little more of a seller's market than a buyer's market. So if you're a seller, put your house on the market. If you're a buyer, I would get out there and start looking as soon as possible. Yeah. And then as soon as you get into a loan, as soon as you get into a purchase and sale agreement, I would get into a loan and get it locked as soon as possible.
Get it locked in, yep. Okay, and so let's jump over to the topic of investment properties. What are the limitations, credit scores required, down payment, that sort of thing?
As far as investment property, we do require 15% down, just for a conventional 1 unit. If you do go above 1 unit, for example, you buy a duplex or a fourplex, your down payment will increase. So if it's, for example, if it's 1 unit, it's 15% down, 2 units, it's 25% down, 3 to 4 units is 25% down.
Okay.
So as far as closing cost contribution, it can be 2%. Gift funds are not allowed. You can do a 10-year to a 30-year term. Also depends on how many properties you own. If you have 5 or more financed properties, that changes some of the parameters of the loan. For example, if you have 5 or more properties, your minimum credit score would be 720. Or if you just have 1 to 4 units, it would be 620 for a minimum credit score. And we do require reserves. And what reserves are if whatever your payment is on the loan that you're getting for your investment property, you need to have at least 6 months of that payment seasoned into a bank account. So what that does is it gives us peace of mind to know that if anything happened, you would have the funds available to make this payment if you lost your job or something else happened, because loaning on an investment property, because it's a second property, is at a higher risk.
Right. Except that, so if you can show there's income in the property, are the underwriters looking at that like as a higher priority over the credit score information, or is it kind of both? Or
the credit score information is going to be foremost. So they will look at the income property's performance, but it has to have been income performing property for 2 years or more, and we will have to look at those tax returns for the last 2 years to see what type of income, and do what we call a rental cash flow sheet on it to see what the actual net income is from that property.
Right. But I mean, are they weighing it kind of heavy on what the income is on that property, or is it mostly on the borrower?
Mostly on the borrower, yeah.
Okay. Because
that's who we're qualifying, is the borrower to purchase the property. So most of the underwriting is done on the borrower's ability to pay and their credit history.
Okay. Okay. And then jumping from investments to first-time home buyers, what does that look like?
Well, our first-time home buyers are kind of what I talked about before, are the Idaho housing programs that we have, FHA, rural development, and then just our conventional 3% down. We don't have any specific first-time homebuyer programs, but we just utilize our investors, which are Idaho Housing, FHA, and rural development, for first-time homebuyers.
Okay. Okay, and then I know I've talked to you guys before about what we call doctor loans. So, and I think is it right? Am I right in assuming it's not just doctors, but like any future income that you can do a loan based on future income?
Well, it is just for doctors, so they're pretty specific on what type of doctors that can utilize this loan. So you have to have gone to school to become a doctor, basically.
Mm-hmm.
So it's for physicians, oral surgeons, dentists, podiatrists, ones that have had to go to medical school, basically.
Okay. For some reason I thought it was kind of just considered a future income program. So, okay, so that's good to know.
We can use their future income. For example, if they have just graduated and they have a contract with Kootenai Health, but they haven't started yet, we can still qualify them on that as long as they're going to start that job within 60 days. Use that contract. I just did one. It just closed last month. That they graduated. They knew they already had a contract with Kootenai Health. Went in, was able to use that contracted income for the loan, to qualify for the loan. One of the other benefits is that we do not count their loans, their student loans, against their debt-to-income ratio, and I think that's probably one of the biggest things is that, and we don't charge mortgage insurance if they put less than 20% down.
Okay.
So those are some of the things that our doctor's loans do, where we help the doctor to qualify for the loan and make it easier for them to, because otherwise if they just graduated from college, from medical school, and they have a contract with Kootenai Health starting in like 60 days and they have all these student debt, and doctors go to school for, almost I think 10 years, maybe 8 to 10 years. So some of them have quite a bit of debt. To not have to use that debt, their debt to income rate is the biggest feature that we have, and that they can go up to $800,000 without being charged a jumbo interest rate as well.
Wowee.
Yeah.
Yeah, that's awesome. That's great to have that as an option.
Yeah.
Okay, so let's talk about people who are self-employed or independent contractors.
Sure. I mean, we do loans for self-employed, independent contractors. The guidelines that we have for that, and people who are just on commission as well but are W-2'd, is that we just need to have their last 2 years' tax returns.
So is there any getting around that, or is that a hard and fast rule with pretty much all the programs?
That's the hard and fast rule, yeah. So we use the income that is reported on the taxes. There are some areas that we can add income back into some of the businesses. For example, depreciation or depletion, we do add that back in. So that will help their net income be a little bit higher. But, yeah, we do have to have 2 years of either business tax returns or Schedule C on a personal tax return.
Okay. Okie dokie. And then we've talked about a lot of the things we wanted to hit on. Just in general, what are your thoughts? We hear a lot of people kind of worried or saying the housing bubble might be coming back again. What are your thoughts about that?
Well, I've been through a couple housing bubbles, but, one was, came down. There's always corrections and everything. It's kind of like the housing market is like the stock market, is what I look at. Long term, it's always a good investment. And nobody can really predict. We all want that crystal ball and to say, oh, my gosh, this is going to last forever. It really doesn't last forever, but I don't think we're ever going to experience a housing crash like we did in 2008, 2009. That was there are a lot of, the lending has changed since then to prevent those type of loans from being created and given to people. So our guidelines are a lot stricter as far as lending to kind of prevent that from happening again. And the housing market, as long as our economy is good and people have jobs, I think that our housing will continue to be awesome.
So you think because of the lending guidelines, they were so lenient before that since they're not?
When I was doing loans back when the housing market was at its peak and people were getting loans that I wouldn't even do for them because they were negative amortizations loans. They were over 100% financing. So, you get into that type of market, and then you start, these people, interest rates, there were a lot of ARMs that were negative amortization ARMs that once those start to come due, people can't afford those payments anymore, and then they start to walk away from their homes or try to sell them and can't. So I think that was what happened during that time, is that, and there were a lot of things with the mortgage-backed securities, and, at one point Fannie Mae and Freddie Mac were buying those loans, and at another point they were like, okay, we have a certain percentage that are not, that are foreclosing, so now we're not going to accept those anymore. So that's kind of what happened there, is they stopped buying those loans, and then mortgage companies and banks that were stuck with those loans, and that's how they kind of went under. And
so you think it's, you're saying it's because the lending guidelines are so much stronger that we don't need to worry about as much of a bubble?
Not as much as a bubble, because the loans that are being created now, even though we do still have some 100% financing loans, those are government-backed loans, VA, rural development, Idaho housing, which you still have to bring in some money on those, and FHA. Those are the only programs out there that require, less than, almost 100% financing. I mean, we do have some that are 3% down, but those are portfolio loans that we keep within our credit union, and our guidelines are really strict. Before, if you had a pulse and a job, you could get a loan,
Right.
So now you have to bring a lot more documentation.
Right. No more stated loans, huh?
Yeah, no more stated incomes, no Ninja or CISA
yeah.
Which I think is really good, because it creates a more stable economy for us, a more stable housing market and lending market as well. So I think it's a good.
Right. Awesome.
Sometimes
okay, did we miss anything? Oh, I'm sorry, what?
I said sometimes it's kind of tough in this environment because not everyone will qualify for a loan, but we do have the government programs to help people that have a tougher time qualifying. So I think we have a good balance right now.
Good. Awesome. So I just want to make sure, did we miss anything, or is there anything that you want to make sure we emphasize?
Well, we do have a program that I don't think we have talked about, was our ARM program. And I know I just talked about ARMs and saying how they were one of the reasons that our housing market, our lending market kind of went down. But our ARM is a very, very safe and good ARM. It's the 5-year ARM, and it starts at a low rate and then adjusts in 5 years, and maximum at 2%, and then doesn't adjust again for another 5 years, with a maximum adjustment of 5%. So that type of program is good for those maybe first-time home buyers that might be moving in 5 years when they have a bigger family, and they can start and qualify at a lower rate, and then are looking to sell their house within the next 5 to 10 years. So that's a really great program, and we don't charge an origination fee on that one either. So it's really nice for some of the first-time home buyers out there.
And what do those rates start at?
Well, let's see what they are today. They're just a little bit higher for oh, they're probably 4.875 instead of 4.5. So there's just a little bump in the rate, but it actually is, we're talking about the ARM. I'm sorry. They're at 3.1 right now.
Okay. Yeah, that makes sense because generally they're less, right, for the trade-off of going up later.
Yes. I was getting it confused with the doctor loan. But the ARM rates, are 3.1. I mean, so even if it increases 2% in 5 years, you're at 5%.
Mm-hmm.
Almost what rates are at right now.
Yeah.
So it's a nice program we have with a nice introductory low interest rate that won't adjust for 5 years. So for those people that are looking to get a little starter home and then do a move-up home in 5 years, once they get some equity in that home, this is a perfect program.
Mm-hmm. Okay.
Yeah.
Awesome. All right. Well, okay. I think so, too. And tell me or tell whoever's listening how to get a hold of you.
Well, there's a couple ways you can get a hold of me. You can you can call me, 208-449-1885. You can shoot me an email, jroth, ROTH, @iccu.com. Or you can go onto my website, which is iccu.com/Janie, Jan as in Nancy, IE.
Perfect. Okay, and does the ICCU website have regularly updated current rates if we go there?
Yes.
Okay.
Yes. Absolutely.
Awesome. All right, and just to close it off, people can reach me. I'm Michelle Garcia, and my website is lakecdarealestate.com. And I think that's it. Thanks, Janie.
Perfect. Have a wonderful day.
Okay, you too. Take care. Bye-bye.